Well, I'd also like to extend a warm welcome to Henry. I think many of you, and we just heard his background from Tim, but probably many of you also know him as being one of the most successful veteran startup founders in the Valley, maybe in Valley history. So it's really cool to have an opportunity to, for all of us, myself included, to be able to learn some things from you today, Henry. So maybe before we get too far into it, I'd be curious to show of hands, how many veterans are in the room? So lots. And of the veterans, how many of the veterans are more kind of on the investing side of the house? Okay, good. So we won't offend too many people today, which is good. How many more kind of startup folks out there? And how many of those are kind of series pre-seed, seed stage? And then how about later stage than that? So most for the most part, mostly early stage. Okay, cool. Well, so to start out, we've asked Henry to just kind of give a little bit of an update for us on Carta as the company. I think there's probably, like me, many really happy Carta customers in the audience, including myself, both personally and our company. And so I think for everybody's benefit, just kind of hearing a little bit about how Carta's doing and what you guys are thinking about these days would be pretty cool.
Yeah, thank you so much for having me back. I don't do a ton of these, but this is the one I always say yes to if Tim will email me. So I love coming to this one. It's very special because it's a veteran closed door where we get to really talk about what it's like to be a vet in Silicon Valley. It's a fireside chat, and we'll talk about anything you guys want to talk about. But I thought it might be helpful, just for fun, for me to do a pitch to all of you. And I remember in the early days, I got very lucky to see a couple of great founders pitch, like Stuart at Slack and Eric at Zoom, and Vlad at Robinhood. And I got to see their pitches in the early stages. They were a little bit ahead of us. And I saw what like a good pitch at that stage looked like, and it really helped me figure out what my story should be like. So I thought it might be helpful. I'll just give you. I'll do a really shortened version of it, but I'll do a 4-slide investor pitch for how I pitch Carta. And we're not going public. Nothing's going to happen like that. But this is the pitch I give public investors. So if I'm talking to a T row and they're like, "Tell me about what's going on at Carta," these are the 4 or 5 slides that I share. So I thought I'd do a quick 7-minute pitch to all of you, and then we can jump into more fun stuff. So I'll stand just because I can't see the screen. So just a lot of people have heard of Carta, but what do we do these days? Quick fun facts about us, just to orient you. So we're about 11 years old. About 500 million in revenue. We've got about almost 2,000 employees worldwide. We've raised $1 billion. I'm shocked too, for this business. I'll try to explain the justification for that. But we've raised it across a bunch of venture capital. But more recently, the last round we did was $500 million, and it was mostly spread across private equity investors, including Silver Lake and Primera. And we've got offices around the world. New York, San Francisco are kind of co-headquarters, but we've got offices in London, Singapore, Abu Dhabi now, Luxembourg, Australia even. So we're expanding the Carta footprint globally, and I'll explain why that's important in a second. So what are we? What do we do? We're an ERP for venture capital and private equity and private credit. So what does that mean as an ERP? Well, our view of Carta is we're a private markets is a 3-layer network where you start with an asset, fund, and allocator. We obviously started in venture, where startups were issuing equity to venture funds, and then of course these venture funds then had to issue LP commitments to their LPs. Obviously there's edge cases, like fund of funds don't fit quite right into a 3-layer network, but it's close enough. And everything we do at Carta follows this 3-layer network of asset, fund, allocator. We've expanded beyond venture, which were our roots, to now we do things in private equity, where we have an asset as a fully owned leveraged buyout company in private equity, or even private credit, where you now have loans against companies, which again we call assets, but those loans flow up into funds that flow up into LPs. So asset, fund, and allocator. So what does that mean? Well, this is what we call an ERP for private capital. So you see on the lower row, we've got asset, fund, and allocator. And then each row if each column is the asset fund and allocator in our network, each row is the back office, middle office, and front office of these businesses. So we started obviously in the lower left corner of equity management, AKA in venture we call it cap tables, in private equity we call it waterfalls. We started in this equity management box. Today of our $500 million in revenue, that's about 370 of it. That's about 2/3 of the book. That once we won that box, it gave us the right to win in fund accounting and fund financials. You might ask, hey, why would cap tables make you go into fund accounting? Well, it's a very similar problem. Cap tables is who owns a company, who invests in a company. Fund administration is who invests in the fund, and now we're doing accounting for them. What's really interesting, though, is we are an accounting company. People think of us as a cap table company, but the cap table is really just the second leg of accounting for an operating company. In an operating company, the problem of accounting is I take revenue, I deduct expenses, and I put everything into retained earnings, and that's what the shareholders have rights to. The second part of the equation is how then I distribute that retained earnings to the shareholders, and that's what the cap table is. We're the second half of this problem of how do I get revenue in a business and get it to the shareholders. But what makes operating company accounting and cap tables simple is everything goes into retained earnings, and you just push that through the cap table. And it's fungible. You just have a bucket of money that gets pushed through the cap table. Fund accounting is exactly the same problem with one exception. There's no such thing as retained earnings. In funds, in partnership accounting, you have to track P&L at the partner level. Everybody who's a fund manager here knows that, and that's what makes it complicated. And that's what we've figured out was we're really an accounting company, but with operating companies, we only had to do the second half of accounting, which is the allocation of economic value to the shareholders. In fund accounting, we have to do the whole thing, and that's how we got into fund accounting. On the far right is our allocators. This is how do the LPs invest in these funds? How do they find the funds? How do they track their commitments? How do they do their accounting on cap calls and distributions and K1s? In the middle row, we've got the middle office, which tend to be things like portfolio analytics, valuations. You know, one way to think about it for the accounting nerds is the bottom row is cash accounting. How do I report the cash that we've invested and return to our investors for the K1s? The second row is GAAP accounting. How do I strike NAVs on these funds? And then, of course, the top row is the front office, the CRM. If Carta today is tracking all the deals you're doing and what you own, we'd also love to track all the deals you're going to do. If we're tracking all the LPs that you have, we'd also like to help you find your next LPs. And those things should be integrated. Today, we don't have a CRM, but stay tuned. We should have one very, very soon. The other thing we found interesting in our ERP is this model works great in venture and private equity. Every module works well, and you can start in the lower left corner like we did and keep working your way out. If we did two small changes, we changed equity management to loan operations and portfolio monitoring and covenant monitoring. This now works for private credit. One of the criticisms of venture, of course, and Carta is that our asset class is too small. Venture is just not a big enough market. Private equity is about 8 times the size of venture, and then private credit's about 3 times the size of private equity. So as we keep moving further up the stack and into different asset classes, the dominoes we can drop keep getting bigger. So you might ask, Henry, there's a lot of theory, you know, a lot of boxes. How do I make sense of what this product is? Well, there's a lot of software. We raised $1 billion to build all of these things. There's a lot of software behind this. But I'll show one sort of video demo of the product. It's just one page, and it's the best example I can give of one screen in the product that tries to highlight everything that happens behind the scenes. And it's this thing we call visual accounting.
This is visual accounting for private equity, part of fund administration and Carta's ERP for private capital. Your general ledger is usually a black box. Carta Visual Accounting transforms your GL into a live map of your capital structure. Here we can see the entire fund at a glance. At the center, you have the primary vehicle, along with its associated feeder and blocker entities. At the top is the fund's SPV and its separate assets and investors. Drill down into a portfolio company, like Viridian Cloud Services, to audit the cost basis against current fair market value. You can trace exactly how that unrealized gain flows upstream to the master fund's net asset value. Afterwards, verify how it impacts a specific LP's ending balance, seeing their net operating income in real time. No matter the complexity of your fund, visual accounting makes it easy to find all of your key stakeholders and entities. Understanding the economics of an LP is simple, even if they're invested through a separate entity such as a feeder fund. But the real power for a CFO is the valuations view. This allows you to isolate specific events in your fund. Let's see the impact of a valuation change. When you book this gain, Carta doesn't just update the asset value. It instantly runs the fund's waterfall logic. It calculates return of capital, clears the preferred return hurdle, and executes the GP catch-up. You'll see exactly how the accrued carry crystallizes on the GP balance sheet. And finally, we can even see how the remaining value increases the NAV for your limited partners. Only Carta's connected ERP brings your ledger, valuations, and carry into one system of record.
And the reason I like to show that video is you can't fake that. That's not like a lucid chart. That's generated from the underlying general ledger and cap table. So you need the cap table, the asset, the company you invested in. When that cap table gets updated, it needs to connect directly into the GL. That GL then has to update the new NAV or the new mark that you put on this company, and then update the fund waterfall that then updates all the LPs. All of this has to be in one system to get this to work. And so that's why I like to show that as one view into what we're building at Carta. So that's my 7-minute explanation of what Carta is working on and what we're doing. And we just continue to take this. Obviously, we started in venture. That's where we grow up. But now we spend all our time in Midtown New York pitching this to private equity CFOs and private credit CFOs. So anyway, I thought that might be a helpful, not just introduction to Carta, but if you're wondering like how growth stage CEOs pitch what they do to investors, this is one example.
Awesome, Henry. That was really cool. Thank you so much. Yeah, round of applause. I noted that at the beginning of that, you mentioned that Carta's not going public, but I was just sort of curious, and obviously it's like, there's lots of things you probably can't talk about, but I'm sort of just, what is the strategic direction of the company? I mean, you guys are printing money at this point, it sounds like, and so I'm sure you get that question all the time. I'd be curious to know what the response is.
Well, it's changing every day. 4 months ago, we're like, we're going public, and now, I don't know if people pay attention, but SaaS businesses are getting crushed these days. And so now we're like, man, private sounds pretty good. So it all depends. There's no rush. We're making money. Liquidity's fine. We'll be independent. I think for a long time. It's just a question of, are we better off independent as a private company or as a public company? And a lot of it, I think, will be dictated by the markets. We'll see how this current bear market fleshes out.
Yeah, it's definitely been, especially just the last few days, the volatility at the individual stock level has been something I haven't seen in quite a long time. Just kind of curious on public versus private, maybe more generally, and you're obviously seeing all of the data. I mean, and certainly private markets move more slowly than public markets, but how do you see that ebb and flow? How has it kind of been progressing over the last few months, and maybe not just the last week or month or so notwithstanding, but do you kind of view that premiums in private markets are still higher, and is that likely to remain so? I'd, again, be curious to hear your thoughts there.
Definitely premiums are way higher in private markets. The classic example is they are different businesses, and Ramp's doing some exceptional things. It's nothing against Ramp versus Navan, but you can just see how private markets are valuing Ramp versus public markets are valuing Navan, and on basic metrics, they're similar levels of scale. And size and profitability and all of those things. So public markets right now are pretty harsh. I think something that might be helpful, I didn't know when I was an early stage investors or early stage founder, is there are different types of investors. In venture, there isn't. It's just there's one type of investor, a venture investor, and they're looking for sort of a 100x outcome and something innovative and novel. As you get further kind of up the growth curve, there are actually different kind of investors. So there's investors that care a lot about just growth, like these kind of growth equity investors and growth at all costs. They're kind of the extension of venture. And then you can find like private equity investors, which are like, well, actually, we don't care as much about the growth side. What we care about is leverage. And so you may be growing 30%, but losing money. we'd actually happily take you down to a 20% growth rate, but now make you a 10% free cash flow, and we'll start trading you on a beta versus revenue. And basically, an investor values you on revenue. They're really valuing you on growth, and if they're valuing on a beta or cash flow, they're valuing on profitability. That's sort of one way to think about it. When you talk to public investors, there's kind of the third dimension was predictability. And so most of the investors there are looking for predictability and a consistency and reliability in forecasting and meeting your forecast. But even within that group, there will be some that will be more growth-oriented and some that will be more free cash flow. So for example, I talked to an investor. I said, if you had the choice, which would you rather see us at 20 and 20 or 30 and 10 or 10 and 30? And he's like 20 and 20, because I just like 20%. I just like that. I think that's like a good thing, because growth can go up and down. But if you're consistently producing 20% free cash flow, I can rely on that. And then you talk to the next one that's a growth equity. And it's like 40 and 0. Like, just go for it, right? Do it all. I don't care about the profitability. And so figuring out, I think in venture, sort of this view is like they are all kind of the same. But when you actually get into later stages, the diversity of investors and what types of profiles of businesses that they want change. And I think that's something maybe important to keep in mind in the early stages, which is in the venture world, everyone's going to push you, just shoot for the 100x. But as you do get a little bigger, you do have choices. Like, you don't have to go to the 100x. You could do, like, I'm doing a 10x, but I'm doing it methodically, systematically, as opposed to rolling dice or gambling on ideas. And then you probably have to get out of the Silicon Valley echo chamber for investors. But there are investors that like that kind of stuff. And so do the right kind of growth model for your business, and then go find the investors that like it.
But maybe just kind of dovetailing on that, you have to make very different decisions early if you're not going to go for that venture outcome, and it'd probably be helpful, particularly a lot of the early stage founders in here, to kind of hear what that thought process needs to be like, because once you kind of go down the venture path, to some extent, you're locked in.
Yeah, there's definitely the cost of over-raising, of over-capitalizing is like a real thing. And you just see it all the time. Like, for example, we're super acquisitive heavy right now. So we did 2 transactions last quarter. We're closing on a third, and we've got 2 more coming by the end of the quarter. And so I'm talking to founders all the time about buying their companies. And the founders that raised an appropriate amount for where the business was, one, it's way easier to have that conversation, and they make a ton more money, like a ton more money. And then the ones that over-raised, it's very hard to get a deal done. Even when the founder wants to do it, it's just very hard to get a deal done. And then even if you do, the founder is usually the one that gets hurt on it. And so we're seeing companies where they raise a ton of money, like literally a company we're talking to, I don't think anything's going to happen, but they raise it at 250. If you actually did growth multiples, it's worth 50. That's barely the pref stack now. And that kind of thing happens a lot. And so I do think there's this problem that if there is this conflict of interest between founders and investors, where if you're a founder, you've got all your eggs in your company. If you're an investor, that's 1 egg of 20. Effectively, for you, this is your preferred stock. For them, it's actually their call option. And so they'd actually, a 0 is fine for them. They want 0 or 100. And they'd actually take a 90% chance of 0 for a 10% chance for 100. But that is probably not your risk profile as a founder. And that doesn't mean venture is bad or anything like that, but it just means you have to understand where you are on that curve and raise appropriately against that risk curve.
Super cool. Maybe just kind of stepping back, and thank you again for doing the pitch. I guess in some ways a little bit of a similar question, but a bit of a different angle, which is as you were doing that, and there's a lot of early stage folks in the room, so as you were doing a pitch for a seed stage or a pre-seed stage investor, how did the approach differ then versus now? The things that you have to honestly put up with then versus now would be really kind of curious to understand how that dynamic is. I'm sure it's much better today than it was then, but the lessons learned probably were pretty important.
Yeah. So I haven't done an early stage pitch in a long time, so you might be better at what it's like now. I can tell you what I've often said from my experience in the early days of doing this, 10 years ago, was back then, I think a lot of founders feel like it's, if an investor says no, it's really a reflection of their pitching ability. Like, I just didn't pitch well enough. I wasn't charismatic. I didn't have the je ne sais quoi. I fucked it up. And my experience was, so much of pitching in early stage is not, I did a good pitch. So much of pitching in early stage was finding the investor that your problem resonated with. And so it's a filtering exercise, not a sales exercise. And I could tell, early on, I could tell immediately, when the first 2 minutes, I could immediately tell if they were going to invest or not. Like, you just knew. They were like, why would anybody need cap table software? Or they were like, I fucking hate cap tables. It's so annoying. Like, and you just knew. And I could have been terribly boring, but they would have got it. They would have got the problem. And so I think one of the things that founders get really discouraged on is they do 10 pitches. Nobody cares about their problem because they found that, unfortunately, the 10 people just don't care. And they think it's because they suck versus, well, they didn't find the people that cared about their problem. I don't know if that's still true, but my guess is that it is, because for a seed stage investor that's looking at 2,000 pitches a year, how do they filter? Frankly, and without data, there's no data. So the only way they can filter is, do they find it interesting, and do they want to spend the next 10 years working with this person on this problem? And and I think there's sort of this view from founders, these investors are smart. They're not that smart. It's not I think a lot of these investors were entrepreneurs that weren't that good. They were, because if they were good, they'd still be doing it. And so, it's just they didn't resonate to your problem.
That's a lesson that took me way longer than it should have to internalize. I can't tell you how many pitches Rich and I have done to investors who, maybe, and our company is wealth tech, which is definitely a niche. And so as a result, there's just a lot of folks that don't have a lot of experience in that little corner of the world. And as a result, they're just asking a lot of questions about, not understanding TAM and things like that, when you're talking to an investor who's experienced in that area, those are not questions that get asked. But we would have saved a lot of time had we really realized, if this investor is not specific to your vertical, it's not worth their time and it's not worth your time. In fact, so much so, it surprises me how many of them still take the meetings, to be honest, because I can't imagine that's great use of their time to sit there and listen to something that they don't know anything about,
Yeah, it is a weird thing. Why do they take these meetings that they don't even care? And again, it's everybody's rational, even if the market is irrational. And the reason they do it is many of them are actually part of the metrics they have to perform is number of meetings that they take. And so they just have to do these meetings, and they have to do the research. And hey, now we're smarter on this field, and I got another company to track, even if I don't know. And just in case it does, become a thing, I've already built a relationship. And they are, they're not really investors; they're salespeople that sell money. And so, how do you sell money? You talk to as many people as you can, and then when they need the money, you try to be there first.
This is kind of a random question, but do you have any sense off the top of your head how often data rooms get opened in Carta and the investors never look at them?
It's a great question. I don't know.
Because in our case, it's 90%.
Yeah, I believe it.
But that might just be a sample size that's too small to be representative. I don't know. Maybe let's just shift gears a little bit to AI. Huge buzzword. Everyone's got it in their pitch deck or their lexicon somewhere. Although I noticed you weren't talking about it too much in yours, but I'm sure you have a view both, on the macro level, but also very specifically to how you intend to implement at Carta. What is your sense of that these days, and where are you all in that journey?
Yeah, we're all in on AI. It's what I do every day. I'd say 80% of my job is just doing change management at Carta and moving us more into an AI world. One way to understand what's happening in SaaS multiples right now in the public markets is sort of all the talking heads and pundits will say like, hey, AI is replacing all these SaaS companies. These SaaS companies are dead. What I think is actually happening is a lot of the SaaS businesses that didn't have a defensible moat or network effect or something that made them really durable, AI will chip away at them quicker than the ones that are systems of records that have a bigger moat. And I'm not saying they aren't at risk, but they certainly have more time to figure it out. But there will be some SaaS businesses that have a defensible moat and are able to transition and move from, call it trad software to AI software. And they, I think, will actually be bigger winners because they've already got a head start from native new AI applications that they can build on and accelerate even faster. So for example, think NetSuite. You would have thought NetSuite would get killed by an AI competitor, but nobody's leaving NetSuite, not quickly. It's a hard thing to rip out. And if Ellison and Oracle, which they're betting big on AI, can actually sprinkle some AI on NetSuite, it's hard to imagine that anybody actually beats them anymore. Like they actually get harder to pull out. They actually become a better software platform and a better company. And so I think the market is trying to figure out which companies have that moat and which ones are going to make the transition. And as markets do, when they don't know, they just sell everything and they wait to figure it out. And so I think of it less as like it's a broad SaaS is going to suffer, but I do think it's going to separate winners and losers through this transition cycle. And the market just hasn't figured that out yet. And obviously we're subject to it. We're a SaaS business, and our job is to navigate. I mean, this is where I spend all my time. The existential threat is that we don't navigate through this transition and come out the other side ahead of everybody versus behind.
My perspective on that would be that you all are sitting on a similar type of data set a different data set than NetSuite, but same idea in terms of the value that has been created around your business. Do you feel like you get credit for that when you're talking to investors? Do they kind of have that same sense?
They do. They view us as very sticky, system of record, all have a big moat. They do push the data thing. We actually have perhaps a contrarian view on data. So we don't have a data product. And the first thing anybody says to me is, well, why don't you should have a data product. You have all the data. And I say, well, it's because we have all the data, we can't have a data product. And there's this like interesting question, I'll pose a hypothesis. You can certainly disagree, but I don't think a software company can also be a software company and a data company, that you can't coexist. And the reason why is that if you're a software company, you build these workflows to help people run their businesses. In exchange for building those workflows to help them run their businesses, they give you their data, which means you can't monetize it because now they don't trust the software anymore. They're like, well, hey, we trusted you with our data, and now you're selling it. And so suddenly it cannibalizes the software business that everybody got to know you for. And my example of this, of why this is true, is Salesforce. If anybody should have a data product, it's Salesforce, and they don't. And so I think the world is bifurcated. You can be a software company, you can be a data company, you cannot be both. There may be some examples that I think are actually exceptions that prove my rule. So when you look in the financial industry, there are sort of these, you see some of these combinations like Bloomberg. You see some of these combinations like BlackRock. But they are so unique in this financial industry where data is commoditized and shared. But if you have unique proprietary data like we do or Salesforce does that customers give us, it's very, very hard, or I might even argue impossible to do. So I think the data with AI is over. People that are saying like that AI, that having good data gives you competitive edge in AI, I'm not completely convinced of that. But what I do think is true is that if you are a business application like you are, and you own these workflows through trad software, through workflows, through forms and buttons, what AI allows you to do, I'll call each of these workflows a unit of work, and that's the phrase we use at Carta now. Everything is about a unit of work. What you can now do is, instead of building units of work through web forms, you can now start taking away these units of work with agents, so that somebody doesn't have to click through this thing, and it just sort of happens for them. It just happens, and they don't have to think about it. They don't have to do it. They don't have to fill things out. They don't have to push buttons. These units of work get replaced via agents. And that's why I think that there's an argument to be made that the good trad software companies will win, because we actually know all the units of work that are happening, because we spent the last 10 years building them. And now if we can go through and rewrite all these units of work in the old way into a new agent paradigm, we win. And so if you look at Carta, for all the founders in the room, like you have UX and you have APIs and REST APIs and gRPC calls to the backend, blah, blah, blah. They're all designed for web UX. What we're doing is making all the APIs agent friendly. So now agents can just call the APIs themselves and do it themselves. And if we can rewrite the user experience via agent APIs, then we think we win. And if we can't, we lose.
On that, and this is definitely something that we've thought quite a bit about in our business. And you made the point, if you have the data, it's really hard to monetize it without losing all your customers in the process and probably getting sued. But one of the things that we're sort of thinking about is are there ways to allow the users to access their own data using those same tools? And in particular, as we nowhere near as far along as you guys are, obviously, but as we start to create more tools, agents, if you want to use that word, that are doing a lot of the work along the way, now all of a sudden the humans that are sort of responsible for overseeing this become a bit clueless as to what has actually taken place. And so they then need other agents to kind of tell them what's happened. And so we're sort of thinking about, are there ways to monetize that could be interesting, perhaps not as interesting as selling to third parties, but is that something that you all have thought about at all or are considering?
We haven't thought about that as much. What we've thought about is one of the things that we think a lot about is, I've had this view that chat interface is the static HTML page of LLMs. It's like the first UX that we could put out that showed what you could do with an LLM. Just like in 1992, the first introduction to the internet for most people after email was a static HTML page. But we all know now that's not the right UX for the internet. And we are quite convinced chat is the wrong UX for LLMs. It was just the best we could come up with right now. And in a few years, people will look back and go, I can't believe chat was so stupid. And you start seeing it now with Claude MD files and and multiple agents, and you can store source code. What we found really interesting is, and this is in the vein of data, but we have customers, if you're a venture fund, you may have different LPA agreements that determine your custom your calculations of management fees, that they're very custom. And in the old days, we would need an engineer to write that. We'd have to write an engineer, and it'd be this complicated thing. And now what we do is we just have the customer write down the rules in the app. Just go tell us what the policy is or the calculation rules. It generates Python code on behalf of the customer, and then it commits the code into our software. And now it's code that they wrote. They wrote via an LLM, but they described it. It's Python code. It gets put into our GitHub. It's called restricted Python, so it's safe code. They can do whatever they want, but they can't access things it's their own sandbox. So they can't access our databases or our secrets.py or whatever. But it's safe code, and then now it's just their code. And we have this thesis that in a future state, a lot of the user interaction that our customers will have with Carta will be written by them. Because now anybody can write code if we give them a framework to write that code. So now they're like, hey, I don't love this report. We already are doing this. I don't like this report. I want my own report. They can just write the code that generates the report for them, and we'll run it for them. And I think that's where the future is heading. It's it used to be you build one version of the software and everybody uses it. I think the world goes to everybody gets their own version.
That's definitely going to be something that's really important in our business too. I mean, as someone who's a consumer of these things, probably just being able to get the reports in the way that you want to get them is is going to be the wave of the future. We definitely are going to start working on that. When you start to think maybe just more tactically about the day-to-day with your teams, are there things that you tell them you can't do this with AI, or don't let the AI touch that? Are there things that you still have, or is it essentially wide open at this point?
It's wild, wild west. The biggest problem for us or me, I should say, and I think one of the advantages you have as an early stage founder is you don't have this problem, which is I have the problem of inertia, of people doing it the way they've been doing it and don't want to change. And so 80-90% literally of the work of moving to AI is just change management. You'd be shocked, but I would have thought when I released and I bought Claude Code for our 400 engineers, they'd be thrilled. Nobody used it. It was crazy. And so we had to do these vibe coding sessions, and I'd make all the teams get together twice a week for 2 hours and vibe code together and just learn and try stuff. And I would pop in and make sure people were doing it. And then once it got going, it got going. And now I was actually just before here this morning, I was in a meeting. So we ship. About 6 months ago, we were on average of shipping about 1,000 to 1,200 pull requests a month is roughly what we did as a company. This month, we're on track for about 2,500. So we're doubling, close to tripling. My expectation is by the end of the year, we'll be doing 10,000 pull requests a month, which is just showing like that 10x productivity, like we're starting to see it happen. And these aren't like made up things. These are like real things. And the challenge, of course, if you're doing 10,000 pull requests, we have a SOC requirement that says we have to have 2 peer reviews for every pull request, or 2 engineering reviews. So if you're doing 10, engineers just spend all their time reviewing pull requests. And so now we actually modified our SOC so that one of the peer reviews could be Claude. And now we're also starting to segment pull requests that go like, if it's Claude generated and it passes Circle CI testing, Claude can just pull request it. It needs no human intervention. And so now we can direct inject software. And so one example of this is we get about 20,000 sentry errors. I probably shouldn't tell customers this, but we get about 20,000 sentry errors, which means bugs in the production platform a month. And it's like silly stuff. Sometimes it actually hurts a user. Sometimes it kind of doesn't matter. But like we get these, and it's just too much for us to process. Now we call it self-healing. Claude is now reviewing every day all the sentry errors. It's diagnosing them. I saw it today in a demo. It diagnosed a race condition on one of our pages where a customer hit an error because it was a race condition. It diagnosed the race condition, fixed the race condition, pushed it for a pull request, approved it, and it got fixed within an hour. And that's where this stuff's heading. It's remarkable.
I can already tell that everyone's gonna. Well, at least I know. We are going to be running back and asking our CTOs about this as soon as we get out of here. I'd just be sort of on the pull requesting, and this is a bit of a nuanced question, but will you actually grade your engineers on how many PRs they're pulling every month? Is that something you'll look at, or not really?
No, we don't grade it on a number of PRs, but it is a proxy for productivity in the sense of like we understand what the engineers are doing. You know, not all PRs are created equal, but why we like it is most of the PRs are now, if you looked at, my guess is not only will there be 10,000 PRs a month, my guess is 6,000 of them were written entirely by Claude. A human never looked at it. Claude found an error, fixed it, submitted it, and deployed it. And we just a human never even did anything about it.
Rich, we got to get on that. Maybe just coming back to more high-level leadership type questions. When you think about yourself transitioning from being a veteran to Silicon Valley, and seeing folks make that same transition today, are there things that you think that Silicon Valley still doesn't really get about veterans? And what was your process like going through that, and how do you see that working today? Yeah,
I think I had a lot of time before in the military and before I got here. So I think I might have had a smoother transition. From some of you that straight out came into Silicon Valley. But something my dad told me, he was an Army officer. He told me a long time ago, because he had transitioned out of 12 years as an infantry officer and then ended up becoming an academic and a professor. And he said, in the military, you're judged by the worst thing you do. And in civilian life, you're judged by the best. And I think if that's true in civilian life, it is like really true in Silicon Valley. And I think that mind shift can be hard for vets we're trained to not fuck up. Like that is our job, is to not fuck up. And to move the needle on AI, to build new product, to pitch investors, like you sort of fucking up is like part of the process. Like you don't get better unless you fuck up. And I think that's maybe the hardest transition I had, and maybe a lot of people do is nobody will remember the nine investors that said no. You just need the one that said yes.
Super cool. And maybe just kind of the reverse, the coming out of the military, many of us have been shaped by that experience for obvious reasons. And are there perceptions that we have that are maybe wrong about Silicon Valley that could hold us back, that would be wise to kind of leave at the door when we come in? Maybe that is one that you just gave, but.
Yeah, I don't know if this is true. I'm curious your thoughts, Lucas, but I can imagine, I've been now in Silicon Valley for 13 years, and sometimes it's hard for me to remember what it was like outside. But I can imagine, you show up, you come from the military, and you feel like an outsider because you kind of are. And so it's just this sort of like, everybody knows more than I do. Everybody knows better than I do. And it's sort of this Steve Jobs famous quote, like, I grew up thinking everybody knew what they were doing, and then I realized they don't. They're as lost as I am. And that is 100% true in Silicon Valley. Most people have no idea what they're doing. They're just really good at faking it. And I think, which may be the opposite. In general, military officers, people that do tours in the military, they're competent, capable people. We just sort of weed out the ones that don't. Silicon Valley doesn't weed them out, unfortunately. So I can imagine that's like one, big difference.
One of the things that I kind of recall about that is feeling like when you're in the military, of course, everything is so hierarchical. And so, it's everything. There's the rank system, of course, is hierarchical, but even the different jobs or MOSs that people have are hierarchical, right? So I was in the Navy, not in the Marines, but in the Marines, it seems like the infantry is held in very high regard, and then other MOSs maybe are not held in the same, and that can be true kind of throughout the services. And one of the things that I don't recall even how I learned the lesson, but early on realizing that shit doesn't apply at all in the civilian world. There are so many different things to do. And in particular coming out, you would kind of, if you did X or Y, that means you're supposed to go into investment banking, or you're supposed to go into some other thing, and realizing that was probably the dumbest shit I'd ever heard in my life. And really finding, and again, it can kind of sound, almost kind of silly, but finding something you are super excited about, regardless of what industry that is in, because if you're pretty excited about it, you're going to end up hopefully being successful in it, or at least having chances to be successful in it, and try to get away completely from that hierarchical mindset. Because whereas before someone is always there to tell you no, it's not really there anymore. And kind of to your point, like no one gives a shit if you failed 10 times, but if you hit the grand slam on the 11th, you're there, Yeah,
100%. I think another way of thinking about that is, Silicon Valley is in the business of discovering outliers. So it's the Outlier founder that's going to, build Facebook. And as a founder, it is actually generally your job to find outliers in your team. You're finding that 10x incredible engineer, that product manager that can, build the next great product. And the military is not good at finding outliers. So that's not what
they want.
It's not what they want. Exactly. Yeah. They don't want outliers.
Yeah.
They want a high average but a low standard deviation.
Yeah.
And in Silicon Valley, we want, I don't know if it's even high standard deviation. We just want that outlier thing. It's actually true in everything. So it's true in people, like not even early stage. We do this like. I bring the 30 top engineers to an offsite with me once a year, or twice a year, and we just spend time together, innovating on stuff. These 30 engineers, we have 380 engineers at Carta. These 30 engineers are probably 80% of the value of the 380. Like it's power law. It's not even high deviation. It is power law in engineering. It's power law in sales. It's just employees are power law everywhere. But it's also power law in products. So we have Carta in our cap table business. We have 5 SKUs, between cap tables, 49A, QSBS, name it. In fund accounting or fund administration, we have 11 SKUs. In cap tables, the number one selling product is cap tables of the 5 SKUs, and it is 92% of the revenue. In fund accounting of 11 SKUs, fund administration is 82% of the revenue. The other 10 SKUs are less than 20%. And so it's even true within product portfolios. One, you need to add the products, just like you don't need outliers as an office manager. You do need people to keep the lights on, open the doors, answer the phone. Like not everybody needs to be an outlier. You do need people to do the work. And just like in product suites, most of you are probably single product companies, but as you evolve, you'll be multi-product. Many of your products will not be hit products, but you just kind of need them. Just like a restaurant has the hit steak that everybody comes for, but you still need to have the salad and the bread. And so you need to add them, but they're not going to be the winners. Our job as founders is to keep finding the outlier product that becomes the winner. And so that manufacturing of outliers and outlying outcomes is so different than what they train you in the military.
Yeah, that was super helpful. Were you giving me the high sign, or were we supposed to wrap up, or do we have a couple more minutes? 10 minutes, okay, good, so that's good. So maybe before we get too far, we should let folks ask some questions. Question from the audience, go ahead.
Yeah, can you hear me okay?
Yeah, sounds good.
Yeah, so Henry, thank you so much for your comments, and I am a big fan of Carta. I'm an emerging fund manager myself, right? I bring UK tech here to the US. I just really have a comment for you. I think I feel really, really strongly about this. I'm probably Peter Walker's biggest fan. And as a PSA to everybody here, if you're in the fund space or if you're a startup founder, you gotta check out Peter Walker and the stuff that Carta puts out. It's probably the talk in the town, I'm sure it is. I'm very thankful and very glad you're not a data company. The stuff, the fact that you can put out data startups every single quarter, every single year, that's data I bring back to companies I'm working with. So thank you for doing that. And I think it goes back to our shared experience as veterans. I think guiding people and helping and passing along to the next generation, it's a huge benefit. So I just want to say thank you for that.
Yeah. Well, thank you. I was in Dubai, I was Riyadh last year, and Peter's amazing, and I was there, and I went to sort of a random founder event, early stage founder event, and I just come in, want to meet founder. I love to go to founder events because I can meet my customers and hear feedback. And I meet this young founder, and he goes, I said, what's your name? What company? And he told me, and he goes, so what's your name? What company? I said, my name's Henry. I'm with a company called Carta. He goes, I love Carta, Peter's company. And I didn't fire him then, but I might tomorrow. This is not cool. Like I'm the,
so there's still some
I'm not
ego?
a huge fan of Peter right now. Yeah. Oh, God, don't tell me about it. I know.
Go ahead.
Great. So really enjoyed listening to you. My company's got about 50 engineers. I really like the idea of 30 engineers that you bring together. One, we kind of have some obvious people that are clearly in that group. Do you have a criteria of how you're pulling those people into that group? And then obviously culture is a big problem that I worry about. Do you find that putting people into that group and then excluding others creates any kind of conflict within your company?
Yeah, it's such a good question. And I've thought a lot about this. I think the world has changed a bit in the last few years. So I think 3-4 years ago, it was harder to be like, look, this is an elite group and that's everybody else. There's just sort of this like more of a equality and inclusion, kind of perspective. I do think the culture of the world in Silicon Valley has changed where that's now a more acceptable thing to do. Then within the company, we talked a lot about this because that was a pushback. Oh, if you don't, people feel bad that they got left out, and they're not wrong. I think there's like sort of two types of reactions. One is jealousy, the other is envy. And those that are jealous, they will work themselves out of Carta, and that's a good thing. And those that are envious will be inspired to be in that group. And so for us, it's the exclusivity of it, or in the military we think about it, special forces. We're not jealous. We're inspired. And that's the kind of company that we want to build. Yeah. And so we leaned into it, and we're like, yes, and it's going to be very clear and obvious. Where it breaks down is if you're bad at it. So you pick the top 30, or maybe in your case, you pick the top 10, and people are like, I don't understand why they're in the top 10. If people get it, they're like, wow, these are really good people. It's an inspiration. If they're like, I don't get it, it feels like a boys' club or a girls' club. It doesn't feel earned. And so that's the thing. And that's why in all of these things, there isn't a criteria. It's I just invite them. And I do my homework. I do a lot of work on every single person. Every single person is invited by me. I also do the same thing for Carta Business School, which is not engineering, but once a year I bring the top 30 young sort of middle managers to an offsite and sort of teach them Henry's philosophies on business. And it's entirely invitation only. I never explain how I decide who comes. I just say, one day you get a Slack that goes, I'd like to invite you to Carta Business School. And these are I think the next, in 5 to 7 years, the next VPs at Carta.
Thank you.
Really neat. Time for one more?
Yep.
Go ahead.
Hey, how are you, Henry? First of all, go blue. I recently found out that you went to University of Michigan a while back. And one of the struggles I've been having at the beginning of my entrepreneurial journey was about besides starting from scratch, a new company, was about how to build a foundational team before scaling up. So I'm pretty sure before scaling up your company and becoming like a multi-million dollar company, I'm pretty sure you had those struggles of how to hire the correct engineers, how to hire the correct team before building the product that you always envisioned before scaling up. So that's basically the question I have for you. It's how you build that foundational team when you started back in 2012 from scratch, and how they were able to support you along the way before scaling up to the multi-billion dollar company. Yeah,
it is the perennial hardest part of being a founder. I might say there's to maybe do a long-winded way to into that question. I've often just said that being a founder, I think, is either a confidence building exercise or a confidence destroying exercise. And so it's one of these things where you start and your idea, people start using it, your confidence builds. You hire a good engineer, your confidence builds. You hire a CTO, your confidence, these things start to build your confidence. You get some investors that say no, maybe your confidence goes down a little bit, but then you find one that says yes, and it keeps building. It can also be incredibly destroying, right? You hire the wrong person, shit's not working, nobody's investing, customers aren't using it, and you just and the problem with the confidence building is it doesn't snowball. You keep having fighting to do the confidence building things, but the confidence destroying stuff does it on its own. It can snowball very, very, very quickly. Yeah. And I think that may be a little bit different than military, which is the military, you have this embedded sort of, brotherhood and sisterhood and commonality that's to support you through the tough times. And maybe that's the inverse of the outliers, right? Is in Silicon Valley, we're working for the outliers of things that keep working. Where in the military, we're one for all for one. We all have to support each other together. Why I tell that story a little bit is I think so much of the early founder journey is that am I doing things that are confidence building or confidence destroying? And so building a lot of the foundational team, one proxy of hey, am I doing a good job at it is, am I feeling more and more confident with the people that are around me? That engineer is doing the thing I need, that product leader is building the thing I want, the salesperson is helping me get sales. Or, gosh, did I make a mistake? Oh, it's not happening. The engineer doesn't seem to be doing what I want. They don't show up on time. Did I, you start second guessing myself. And the reason I say that is it doesn't get better. Like, whether you're in the news, investors, want out, the board's mad at you, whatever it is, your exec team, an executive quits on you. Like, it's just like all these things like keep hitting you. And then finding out what are the things that rebuild that confidence or continue that confidence building exercise. So it's a very theoretical way. You can read all this stuff on like the right person and all this kind of stuff. But my best proxy for building a team is, does a team around me make me more confident or less? And that tends to be a good heuristic for am I making the right decisions?
That was awesome, Henry. Thanks so much. Before we let everyone go, I'd like to just do one more show of hands. For all the veterans in the room, please raise your hands. Okay, so everyone, thanks for your service. And please keep your hands up if you are also a member of the Marines Memorial. Okay, so if you're a veteran and you're not a member of the Marines Memorial, then your homework assignment before you leave the building today, when you go out down on the lobby floor, you'll see lots of QR codes all over the place. Just scan the QR code, sign up to the Marines Memorial. This institution's been here for a really long time, since 1946, and it needs a lot of support from folks like all of us here in the room to keep it going for the next 100 years. So once again, everyone's homework assignment, sign up to be a member of the Marines Memorial. Thanks so much for your attention today. See y'all.